And U.S. 30-year bonds are up for a sixth day, posting their longest winning streak since December of 2008. So is inflation perhaps no longer a concern for traders? Well, joining us with some answers is Ajay Rajadhyaksha. He's the managing director and head of U.S. fixed income and securitized products research at Barclays Capital, and he joins us now from his firm in New York. Ajay, thanks so much for joining us.
Sure.
Tell me, I think a lot of people are surprised that Treasuries have rallied since the beginning of the year, and yields are pretty low at the moment. And just last week, we were talking about inflation concerns.
Yes, I think they've rallied for a couple of reasons, not entirely related. But the first one is that the bond market still seems to be giving Congress the benefit of doubt as far as the debt ceiling negotiations go, that the debt ceiling will be extended, that Congress will get its act in gear. And the second, as you mentioned, Lisa, is that the economy has slowed. There might be one-off reasons, but the fact remains we grew at 1.8% in the last quarter. And more critically, unemployment claims for the last 3-4 weeks have been trending upwards. A bunch of one-offs, for example, supply disruptions due to the Japan earthquake might have been part of the reason in 1 week. The Easter weekend related issues might have been another reason. But if this continues for 1 to 2 more weeks, people are going to say, okay, this is clearly a trend and the labor market is starting to weaken again. And that, I think, is what bonds are reflecting right now.
Ajay, is tomorrow's employment figure critical in your mind, what that figure is, whether it's stronger or weaker or better than expected?
Not as much as most payroll numbers are. And the reason is because the last 2 weeks where, like I said, jobless claims have clearly trended upward, are far more likely to show up in next month's employment numbers, not tomorrow's. So unless tomorrow's number is a big change from consensus, I think is at 200,000 in payrolls being created, unless you get, say, a 400,000 number or something that is negative, I think the market is going to look through it.
Ajay, I was asking you about your 10-year forecast. I mean, we have seen some other firms, research departments, actually remove their bearish bets, right? Morgan Stanley, Goldman Sachs this week. Where do you stand on the 10-year?
Well, we were never as bearish as those firms to begin with, but now we think they might be going too much in the other direction. For now, we still believe that the U.S. recovery remains on track. Yes, we have hit a soft patch, but across the rest of the year, we think the economy will still grow at about 3.5%, a very different scenario from the first quarter of this year. And second, I do think at some point bond markets start to get worried about what Congress is doing, whether it is getting its fiscal act in order or not. So what we think happens to a 10-year is that rates rise, but gently over the next several months. So not a terribly big move from here, but I wouldn't be surprised if rates end the year 40 to 50 basis points higher than where they currently are.
Ajay, explain gently, where do you see the 10-year yield?
So right now, the 10-year, depending on any given moment during the day, is anywhere between 3.2% to 3.25%. We think it will probably finish the year at close to 3.75%.
What happens in June when we're expecting the end of QE2, end of all that liquidity that's been injected into the system?
Mm-hmm. It matters, but it matters over a period of time. The Fed clearly has been one of the biggest buyers of U.S. Treasury debt for the last several quarters, but we don't anticipate a knee-jerk reaction of bond yields heading higher once the Fed stops buying. Rather, far more likely is that over the next several months, this will start to get reflected in yield levels. But again, like I said, that is not the main factor. If you told me that Congress strikes a deal on entitlement reform, on tax reform, on some sort of revenue increases over the next 3 to 6 months, that I think matters far, far more to where 10-year bond yields are headed than what the Fed does over the next 2 months.
And what happens, I mean, you said that right now it seems as if the bond market is putting a great deal of faith in Congress's ability to come to a deal. Mm-hmm. What exactly does the deal look like? You mentioned a few of those components just there. And what happens when they don't come to an agreement, or what's the catalyst for the bond market to start getting nervous?
The best case scenario is obviously that the debt ceiling is raised. Yes, we do need spending cuts, we need entitlement reform, we need tax reform, but purely from a bond market's perspective, if the debt ceiling is raised, then that is one hurdle out of the way, one thing less for the bond market to worry about. The ideal scenario, like I said, is if that happens in conjunction with a longer-term package to get our deficits under control. The worst-case scenario, to answer the final part of your question, Lisa, is if May passes and then June passes and then July passes, and we are getting very, very close to the point which Treasury Secretary Geithner has said is the drop-dead point, the first week of August, beyond which Treasury does not have money and the debt ceiling has still not been raised. Starting in June, July almost certainly, I think the bond markets will start to get very, very worried. And the way they will show it is in terms of very long yields starting to rise.
All right, Ajay, thanks so much for joining us.